We have CNBC contributor Don Luskin of Trend Macro, CNBC contributor Michael Farr, president of Farr Miller in Washington, and Darrell Jones, managing director, Hedge Eye Risk Management. All right, Darrell Jones, throw a wet blanket over this amazing story. Let me start with you. You are least bullish. You are our bear. Throw a wet blanket over this story.
Well, Larry, I think, number one, you kind of nailed it on the head. Expectations are very lofty right now. The market has had its most expedited move in almost a 24-month period than we've ever seen in history. 96% move from the bottom. The last time we did this was 1936. I don't think we're going to have another 1938, but there are expectations embedded in that. In the short term, the stock market at 1340 on the S&P is 3 standard deviations overbought. So, you know, there's been a lot of good news, but a lot of it's in the rearview mirror. And I think on the horizon are, you know, a stock market that's at best fairly priced and a lot of risks in the future.
Don Luskin, what do you make of that? Stock's too high? That's basically Darrell's bottom line. Stock's too high?
Well, Darrell's arguments are basically technical arguments, and it's kind of hard to disagree with them on their own merits, I suppose. You know, one way of putting it in simpler terms would be to say we've had 84 days now without so much as a 3% correction. And history tells us that, look, you're going to get a little bobble after you've had a run like that. But I got to tell you, I don't see any reason why we ought to have some kind of major correction. I don't see why we should experience the kind of 15, 16% correction we had in the late winter and spring of last year, because we're just not getting the kinds of event shocks that cause that kind of market reaction, number one. And number two, stocks aren't as cheap as they were at the bottom in March 2009, thank God, but they aren't as expensive as they were in April 2010. The forward PE ratio on the S&P is about 13.5 right now. It was 15 in April in 2010 when we embarked on a serious correction. So if there's going to be a little technical dip here, I would see it as a buying opportunity, and I wouldn't wait too long to do that buying.
Michael Farr, you have individuals in your money management company, do you not?
We do.
All right. Are you telling them to stay the course? Are you telling them to stay along? Are you telling them to be cautious? What are you saying? This is an amazing run-up we are experiencing. I mean, year-to-date alone, I don't need to tell you guys, we're up about 5.5%. That's just year-to-date. Michael, what are you telling your folks?
Well, Larry, I tell them always the same thing, that you stay the course, that you can't time this, and we don't trade them. Our average hold for a stock is around 4 years. So, you know, we're always studying the fundamentals and trying to buy things that are a little bit out of favor, and we tend to hold them for a long time so that we can see the value, and the earnings really drive shareholder prices and shareholder value, and we make our money kind of the slow way over time. So I don't think, but I kind of agree with Don. You know, I think that the market here is due for some sort of a pause. But I can't see how it's going to be a major pause. We've had Chairman Bernanke out. Chairman Bernanke said he wanted to see share prices higher. And they're going to continue with QE2, and I think they're going higher.
All right, but you were at Jeff Lacker's speech, the Richmond Fed head, right? You saw his speech. You heard his speech. You were something with his speech. He said 4% economic growth. Now, I think that was extremely significant for today's market. That is a very bullish, optimistic forecast from a senior Fed guy, Michael Farr. What did Lacker say? And was it important, by the way, in today's trading?
I do think it was important, clearly, in the early morning trading today. I was at the Lions Company seminar at University of Delaware. I was a co-speaker along with Senator Don Nichols with Fed President Lacker. And Fed President Lacker did say 4% GDP growth for 2011. He saw conditions basically improving, is what he said today. He said that it was time to reassess QE2. He said that there would be points when they first brought on QE2 that they would re-examine it, reassess, take a look at the current conditions. He thought it was time to do that. He said he wouldn't stop the QE2 right now, but he thought it was clearly time that they ought to be taking a close look. And overall, he sounded fairly constructive about the economy, that it was gaining traction, and he felt optimistic.
Very, very bullish. That's the way I read that as far as reassessing QE2.
Very smart guy.
We're going to talk to Ron Paul later in the program about that. But, Darrell Jones, let me come back to you. Don't be technical with me. I want to ask you some important stuff. Consumers are rocking. And the retail sector is all of a sudden rocking again. After a phenomenal 2010, it's rocking again. You got front page story today in the Wall Street Journal that consumers or individuals are actually buying cheap homes for cash. Housing affordability, we're going to get into that in the next segment, is the best it's been in 10 years, according to Mark Zandi over at Moody's. What do you make of that? The consumer sector now seems to be keeping pace with the extremely healthy corporate sector. Darrell, doesn't that look like win-win?
Well, number one, I just want to address Don's earnings argument. I think to say that the market's trading at a multiple of 13.5 or 14, that really depends on your denominator. And something
too technical. I don't want to do technical. Come on, move on. Talk to me about consumers. Why did the consumer index do so well today, the retailers, and why did the home builders index do so well? Something's going on here.
Well, I think in the short term, these especially the home builder index can have a small bounce, but there's still massive wins when it comes to the home building sector, massive supply both in the system and on the balance sheet of banks. So we may get a marginal pickup in home prices, but we still think there's 15 to 20% downside in home prices. And as it relates to the consumer, this is something you and I have talked to in the past, but inflation, in particular the commodity inflation, is a real headwind to the consumer in terms of spending. Think about gas prices, but also to the retailers and to the retail index itself. Margins in 2 to 3 quarters are going to look a lot different if commodity prices stay at these current levels.
All right, so that's an issue. That's a glitch, potential profit margin shrinkage from the high commodities. But, Don Luskin, one of the other things that's been happening in recent days, long-term Treasury rates are going up. They're going up quite a lot. They're back to 3.75%, 3.75 on the 10-year. The 30-year is what? It's about 4.75%. The 30-year mortgage rate is about to go through 5%. Now, Don, is that good or bad? Is it a growth signal, an inflation signal, or what? How do you read this rise in interest rates?
I think it's a growth signal. It's also a not the end of the world signal. We got used to extremely low interest rates starting last summer when everybody was just absolutely sure we were going into a double-dip recession. We had the 10-year in the 2s. We had 30-year fixed-rate mortgages down almost as low as 4. So those things have all just basically come back to where they were, about this time a year ago. So it's not like we're having some gigantic backup in interest rates. We've just simply lost this kind of end-of-the-world premium in safe haven assets like Treasury bonds. And that's great. That's fantastic. That just means that the sword of Damocles has been taken away from the economy. That is absolutely a growth signal.
No end-of-the-world scenario. I like that. No sword of Damocles. I like that. I've never actually met Damocles as long as I've been around, but I look
He's a really nice guy, Larry. You'd have liked him.
Michael Farr, let me just ask something here in Washington, D.C. President Obama goes to the Chamber of Commerce and tells business yesterday, I love you. Today, in the front page of the newspapers, his administration leaks out the fact that they are going to slap a big, whopping unemployment insurance tax on businesses. Now, if that isn't a hosing, if that isn't a double cross, I don't know what is. Now, doesn't that just get your back up, or are you immune? Are you immune to these political developments that might affect business?
I'm not immune at all, but I'm certainly getting a little more callous, and it's much tougher to shock me these days, Larry, when a politician forgets to deliver a little bit of bad news that perhaps they'd forgotten to share with you. The problem is, not only clearly did he not want to share that when he was at the chamber, but, it is a piece of bad news, and it's just not good for business. You don't tax yourself to prosperity. You don't keep raising rates to encourage business formation, to encourage a business owner to go out and hire. So on the one hand, they just keep adding to this policy instability and the doubts that business owners have that really keeps the money in their pockets and is really putting, I think, a significant headwind on this expansion.
Right.
If they would keep these tax rates low and if they would keep policy stable, business owners could make some really constructive decisions.
So you sound like Don Luskin. So let me give Don Luskin the last word. Now, this goofy tax, Don, is not until 2014. But there are a lot of regulatory obstacles to profits. For example, Obamacare is going to be kicking in the next couple years. The EPA is going to try to stop the flow of any oil and gas drilling. The FCC wants to regulate the Internet. I know President Obama says he's pro-business. I always say trust but verify. I'm not seeing the verification part. Don, what is the impact of Washington politics and policy right now on this major bull market?
Washington politics and policy is always a wedge that gets between buyers and sellers in a free market economy. And when that wedge is getting driven deeper, it means there are fewer transactions and the economy grows more slowly or shrinks. And when that wedge is being withdrawn, the economy can grow again. That wedge is being withdrawn, thank God. But the only reason it feels even slightly good is because a year ago, it was just in there so deep that we were just driving ourselves into permanent recession. So fine. So Obama goes to the Chamber of Commerce. Commerce, and he says that he wants to be the next Ronald Reagan, and we get Obama and Reagan on the cover of Time magazine. Oh my God, no wonder Time magazine is about 8 pages now. So, and then he comes and he puts this new tax on business, so I guess that kind of makes him out to be a liar. But still, the wedge is being withdrawn, and that is
the
good.
Tea Party Republican Congress going to withdraw the wedge. Good stuff. Gentlemen, thanks. I got